Hey folks, it's Simon here. Welcome to your Tao Daily video for Wednesday, the 17th of July, 2024. So Wednesday felt like a pretty rough day on the market. If you look at the indices, the S&P was down 1.4%. The Qs, the NASDAQ ETF was down almost 3%. And the semiconductors, if you look at SMH, was down over 7%. And if you have a look at the market map for the day, you can see the weakness really concentrated in big tech, software, and semiconductors. All right, so the stocks that have been leading the charge are now kind of reaping the reverse rewards. Now, something to be aware about this sell-off is the fact that the put-call ratio has been indicating that everybody's long for several weeks now. Now, the put-call ratio here, it's not a precise timing tool. Sometimes it is, but it shouldn't be viewed that way. But it does give us a good window into how long or short the market is. So just as a quick reminder of how this works, when the put-call ratio gets above 1, this is the 10-day moving average in the white line, that's an indication that everybody's short, everybody's panicked, everybody's rushed out and bought puts, and that's usually when you get a market low. And then when it gets below 0.8, that means everybody's long. Everyone's like, oh man, this market looks so bullish. Let's buy calls till our eyes bleed. And that's usually when you get near a market top. Now, like I said, it's not always that precise. All right. Sometimes you can get these areas that, regions of kind of length, or rather panic and length, and they can last a while. Back here, okay, the put-call ratio was giving bearish warnings for a few weeks, and eventually we got a market top, which led to a 10% pullback. And then we had a put-call ratio that was excessively bearish here, which gives us a counter-trend bullish signal, and of course that led to the massive rally we've seen since then. Now here the put-call ratio has been as extreme as it's been in at least a couple of years, and we could expect a market top to come into play here, which is kind of what we're seeing. And given how out of whack the put-call ratio is, I think it's going to take more than a couple of days of selling to kind of correct the imbalance here. In other words, I don't think we're going to get a garden variety, pullback to the mean kind of sell-off here. I think it could be worse than that. In fact, when I look at the market, I feel as though in the short to medium term, next 2 to 4 weeks, it's probably probably the only direction is lower. All right. If we zoom out to a weekly chart on SPY, you can see we've hit a 1.618% Fibonacci extension of this bear market we had in 2022, from the 2022 high to the 2022 low. If we look at the Qs, which is the ETF that tracks the NASDAQ, again, taking the late 2021 high to the 2022 low, we literally just wicked the 1.618 Fibonacci extension, almost perfectly there. And the other thing with the SPY, we've got 7 bearish divergences coming in with the divergence blueprint indicator here. Now, the market did register a Whaley breadth thrust yesterday, and that has definitely got bullish implications for the S&P on a 12-month view. But I think on a 2 to 4 week view, it's going to be more a case of hang on to your hedges if you've got them. That's what I got for you. I hope it helps, and I'll catch you tomorrow.